Hi, and welcome to the Bond Show, where we talk macro, try to make sense of markets that really don't make any sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because, as you know, bonds are up. I must be pretty excited as we see the macro thesis play out. And why am I calling it the Bond Show today? Because if you know macro, you've got to know the bond market because the bond market is macro. You've got to know it. And the cool things are happening. We're going to take a big look at some charts today and see what's going on in the market, look at the economic data, and yeah, I'm pretty pumped up. Not just because I'm long bonds, although that would probably have something to do with it, but what we're seeing in a tactical breakout is really important because, remember, we talk about the relationship between stock and bonds and what happened today. Yields went down. As I've said, they're going to. And guess what? Boom, stocks went down too. Everyone says, no, that's not how it works. It is how it works. And today is more evidence of that. Let's get into the weekly data. Let's see what's going on. Let's fast forward right into Thursday and continue. Let's see, jobless claims, which remember, this is supposed to be going down. You don't get 1.48 million jobless claims each week if things are getting better. This is a sign that things aren't really improving at all. And we can look at the 4-week moving average, and it's slowing down. It's sitting at 1.6. So this is probably going to get down to, say, 1.5-ish, 1.4, and suggest that, no, things are getting worse. And I mentioned in previous episodes that the first round of layoffs was mostly due to college or high school educated people. The next round is college educated, the managers, supervisors. The third round is going to be government employees, and then the cycle is going to restart all over again. Look at continuing jobless claims holding steady. Now, of course, the market said, hey, it dropped about 800,000. Yeah, there's still 19.5 million on continuing jobless claims. The real number, because this does not include all forms of claims, is 30 million Americans are currently receiving jobless benefits. Staggering. And everyone thinks there's going to be an economic recovery. Not with 30 million people unemployed. There's certainly not going to be. And in the third week of July, the last check for the extended unemployment benefits goes away. No sign if we'll have an extension of that or if there'll be something else. But remember, when that goes away, people's income is going to be lower than it was before they went on unemployment. How about durable goods? And this is a really critical thing we need to look at is durable goods went up 15.8%. And that sounds like a huge number, and it is. But it's relative because it's a month over month. It went up after an 18% drop the month before. Excluding defense, we had another big number, 15.5% jump, but that's after an equally dismal number the month before. And core durable goods, only a modest 4% increase after sliding 8% the prior month. Let's look at a chart of that. And this is, I'm just going to give Chris Dark credit for this because really it was somewhat of a collaboration, but calling this the Dark Van Metre thing does not sound good at all. And no, so we won't call it that. I'll just give him 100% credit for this. And this is the new orders for durable goods, less defense spending, and less, non-defense aircraft and parts. And this was designed to find out what's going on with the consumer. And so we can see the consumer on a year-over-year basis, it improved to minus 18.3%. But remember, we look at the Cass Freight Index, and the Cass Freight Index nailed this. It's the freight said, hey, look, there's no sign of recovery. And certainly when we look at durable goods new orders from the consumer sector, you don't see it at all. Now, how about when we look at institutional money funds? A lot of people don't realize that there is a correlation to the market or the economy. When people start selling their stocks and putting it in cash, it has other effects. And so I took institutional money funds and inverted it against the Chris Dark consumer pulse of durable goods. And look at that. All that money, now this is inverted, that moved into money market funds. Then remember, this is institutional. So this is brokerage accounts, IRAs, qualified plans. It predicted the big drop in durable goods new orders. So as people got concerned about their money, they also stopped spending. Isn't that interesting? And how about when we overlay consumer price index? Well, you can see nice relationship between the two, suggesting that, hey, this move down in the consumer price index was completely validated by a lack of new orders or new order demand. So just think, at a negative 18% year over year rate, that's not good for the economy. Not good at all. Let's move on. Well, we see retail inventories excluding autos fell in May, which is good for retailers. Consumer spending, I'm not worried about the Q1 numbers. Wholesale inventories were down month over month. So that's just validating that we know that retailers and wholesalers are trying to trim down some of their massive inventory levels. We see Tokyo CPI down slightly to 0.3% from 0.4% the prior month. This is, again, sign of disinflation. This is a June number, so this is good. Let's move on to today's information, which is now I can't remember what it's called. Personal consumption expenditures, PCE, and this is the Fed's preferred gauge of inflation. They're interested in the CPI. They're really interested in PCE. And on a month over month, we see PCE improve from negative 0.05 to plus 0.1, but on a year over year basis in May, it slid disinflationary from 0.6 to 0.5. Looking at core PCE, which is excluding food and energy, flat on a year over year basis at 1%. Now, what's interesting is if we go over and chart this, we can see that I pulled personal consumption expenditures, and on a year-over-year basis in May, according to the Fed database, it's at minus 9.3%. So I don't know why the chart over here suggested otherwise. Oh, this is the price index. Maybe that's what it is. So prices are falling. I suppose I missed that. I thought that was the actual index. But anyways, it's still worth noting that if you look at the Fed's preferred gauge of inflation, it crashed at one point by minus 15.8%. And you'll notice that the consumer price index lags this. So I know a lot of people think, well, there's no way the consumer price index is going negative. Well, personal consumption expenditure says it does. Now let's go back and correct that I misread this today. The price index suggests that pricing power is disinflationary, and that just adds to the broad theme of what's going on. When you look at this PCE chart, you go like, oh, wow, that means the consumer price index is about to take a massive plunge. And again, I think the banks know this, but the market hasn't quite figured it out yet. Now, the news reported that personal incomes have dropped 4.2%. This is because government transfers are starting to go away. Personal spending had a huge surge, but remember, this is a month over month. So after collapsing 12.6% the prior month, it improved 8.2%. On its own, that's a big number, but it's 8.2% increase from the prior month of a minus 12.6% drop. Inflation-adjusted personal consumption increased at 8.1%. Looking at the University of Michigan, consumer confidence across the board, consumers were confident about current expectations, their sentiment, and their and future conditions. Or let's see, expectations, current conditions, and their overall sentiment all rose, but their inflation expectations fell, which is highly bond bullish. Let's look at how the large commercial banks are positioned. This is very interesting what we're going to see here as well. Let's clear off some of these tabs. And what we see, securities and bank credit, jumped. Actually, was that the rate? Yeah, that's the one. Securities and bank credit, look at that big increase there of what, 47 billion in securities, meaning banks were buying lots of bonds. They did shed some mortgage-backed securities, but they bought a massive amount of Treasury securities to the tune of, looks like 47 billion of Treasury securities. When everyone said nobody wants Treasury bonds, all of a sudden the banks are mopping these things up, and they bought some non-government and mortgage-backed and non-government-backed agency bonds. So the banks are buying bonds in big, massive numbers over the last 3 weeks. That tells you they know something is coming and everyone else doesn't. They wouldn't be buying these if there wasn't a reason. How about all loans and leases? Big drop in lending as commercial industrial loans just flat out collapse. This is not an indication of anything beyond commercial or corporate borrowers refinancing their revolvers. I doubt many of them are paying them back. Just deciding they don't need them anymore. They're probably paying them back with other loans. So we predicted this would drop. There it is. How about real estate loans? Finally, a little bit of an uptick. $6 billion in real estate loans passed through the system. Commercial real estate down $1 billion. How about the consumer? Remember, all of this talk about the recovery, the real answer is what's going on with the consumer. Well, total consumer loans dropped $2 billion, but more interesting, credit cards dropped about a little over $3 billion. So that tells you consumers are still concerned about their debt. They're still paying things down, and there's no recovery without the consumer. Let's go over and take a look at the broad charts, and we'll come back to the piece on the M2 momentarily. So the M2 money supply, the growth rate change is at 24% and still rising a little bit. The 6-month rate of change is rising. The 3-month rate of change is starting to fall. Now, what's going on with the money supply is institutional money funds are falling. So investors are coming out of cash and buying in the market at a high point. Is that a surprise? No, that's generally what investors do. So we're seeing money flow out of institutional money funds. However, we're seeing a pickup in other checkable deposits, and savings deposits are down a little bit. So most of this is being driven by checking accounts are seeing an influx in cash, whereas money funds and savings accounts are seeing a little bit of a decline. So that is to watch, because as money flows back into the market at its peak, that's generally not a good sign. It's certainly not a bottom. That comes later. All right, so the monetary base was unchanged because the Fed doesn't report this week, and the money multiplier, as a result, ticked up slightly to 3.6%. But based on what we're seeing with the Fed, and they announced this week that they're pretty much going to continue their quantitative easing program at their current pace through the middle of next month. So no changes there. As they get caught up, things are going to change, which reminds me, I wanted to look at a chart of sometimes I forget before I push record what charts we want to look at, and there is one I did, the repo operations chart. Let's go jump on that and see what's going on there. And the repo loans have died down a little bit, and that's kind of what pushed bond prices or interest rates back up. And we can zoom in and we can see this decline here in repo loans kind of pushed Treasury yields up and now starting to slow down. So there's $70 billion about outstanding repo loans, not a terribly large amount. Clearly the banks are accumulating bonds. These are still sitting on commercial bank balance sheets, so there's nothing here to tell us other than that draw off is probably what drove yields higher. Anyways, back to PowerPoints. So we should start to see the money multiplier kick in and reverse direction, where I'm trying to find, there it is. But in the moment, it kind of ticked up a little bit, but no major inflationary pulse. The Fed's still going to run QE. They're probably going to start catching up pretty quick with the M2 now that we're seeing those repo loans start to settle off. Looking at real estate loan growth, down to 3.52%, even though we saw a week-over-week increase. 6-month rate of change is flat at 1.24. The 3-month rate of change went negative for the first time since 2013. And what does that tell you? Record low interest rates on mortgages is not driving enough new loans in the housing market. This is bad news. You do not want to see a contracting, or you don't want to see lending contract in a debt-based economy. It's bad news. It's a symptom of more to come. How about commercial industrial loan growth? It's falling, no surprise, as corporations pay those revolvers back. Growth rate's down to 25% from a year ago. But look at the 3-month rate of change. It's falling quickly to a little under 7% from this on a 3-month rate of change. How about loans and leases at all commercial banks? Growth rate is down to 8.9% from a year ago. The 6-month rate of change is falling, and the 3-month rate of change, courtesy of the real estate market, is down to 0.19% and falling. This is about to go negative. That is something that only happens in recessions. Now, you notice that the 12-month rate of change doesn't bottom till after. That's because the 3-month rate of change is leading. Wonder why the banks are buying bonds? They know things are about to get much, much worse. And let's look at that credit card growth rate down to minus 7.71% from a year ago. Look, we're seeing a little V-shaped in the economy, a little fish hook. I shouldn't say V-shaped because it's not. It's a fish hook. You're not seeing it in the credit cards. Tells you consumers are not spending as much as the data is indicating in terms of they're not using credit. They're paying cash, and that is not a sign of confidence. When consumers are confident, they charge and pay later. When they're not, they're going to pay in cash. So very, very interesting of what is going on there. So let's clear off some of this stuff because I want to look at some charts and see what's going on in the bond market, why we're seeing a breakout, why we're seeing equities drop. Because again, this is kind of exactly what I said would play out. The Fed would eventually get caught up buying enough bonds through QE, credit would start to contract, and the system starts to go. And now, why are the banks buying bonds? They know what's coming. They know it before anybody. I mean, they have all the information. They see checks coming in. They know who they're coming from. They see bills. They've got all the loans. They've got the credit card loans. They see money flowing out. And in the short term, I'm going to guess we're going to continues to see some inflation in the M2 as people start to hold on to money. That's kind of my prediction is we're going to see people, remember, these extra checks from the government expire soon, a few more weeks. And people know that, and they're starting to figure out their jobs are not coming back. And if they are, they're not going to be making the same wage. My prediction is they start to hold on to money and we see spending go down. So we'll see how that plays out. But the Fed, remember, that money multiplier is key. The Fed's going to maintain a minimum rate in their asset purchases at least through the middle of next month. And from what I can tell, they're picking up a little more of those long bonds. They're trying to bring long rates down. And why does that make sense? Because real estate loans are contracting now. And that is one of the biggest sources of lending growth in this economy, and we need it to grow desperately. If there's going to be a rebound, it's going to come out of real estate. You're going to watch. This thing's going to have to bottom at some point. So the Fed knows what's going on. The banks know what's going on. Investors, not so much. All right, so let's take a look at some charts. So here's the 10-year Treasury yields, and I've cleaned off some of the lines so we can look at them elsewhere. But I want you to notice that there was this topping pattern inside of a bigger topping pattern. So what's the bigger topping pattern? Is you have this massive structure here, and everyone saw this drop and said, bullish, 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 yields are going way back up. And my answer was, look, all these people that accumulated Treasury bonds since 2012, they haven't sold them all yet. They need more time. So if we look in here, we see a second topping pattern, a small one, starting back in April. And look, it broke the trend line. Now, it broke the trend line here on 30-year yields, and I want to show you why this is important and why trend lines do matter. So let's go to the drawing tools, and we'll get the price level. Because what happens if this starts to break lower, it starts to cause the people that bought, say right in here, to exit their short positions. And we can even draw a line across to here. So here, people that were short treasuries are getting squeezed out. Well, what's the next level? Well, then we're going to pick up these people right here. Not a lot of them, but there's a few people here. And then how about some investors right under here? And then some bigger move here, and then a move down here, and all the way to the bottom. And so this is what happens when you see these trend lines get broken, because all these buyers, in this case, these were sellers because the Treasury yields went up. So they were selling bonds, now get squeezed out of those short positions, and it causes yields to drop. So it gives us a very clear picture that there's going to be at least a retest of this low. There's going to have to be because we need to see a double bottom. But again, my view, especially when you look at real estate loan contracting, this thing's headed to the floor. Because if we can't get real estate loan growth right now at record low interest rates, and I know the housing market's moving, I see the data and I'm baffled by it too. But if we don't see growth in the real estate lending market, yields have to keep falling. Great news for the long bond. So I wanted you to see how this looks. Now let's go and look at the inverse of this, or Treasury bonds, TLT, And this is really critical. It broke its 50-day moving average. Now, again, I'm not a person who trades moving averages or movements through, but a lot of people do, and a lot of people like them. And all it's telling us is for the last 50 days now, the average price of TLT is higher and it's trending up. And again, you can see all across here, if we drew all those little lines in, you can see where all the sellers were at and how they're getting squeezed out. Now, the next major point where I suspect we'll see resistance is right where this dotted purple line is. And I haven't moved it, but this is their sellers here and their sellers here. And my guess is they're going to play defense and push back a bit. And then the next final move is up here right around 1.2% on the 30-year where there's quite a bit of selling. Break through there and you're off into the next, or probably the last major bull move in bonds on their way to yields hitting 0%. So I'm very interested in seeing this play out, but there's that trend line. And what's also interesting to me is this trend line started hitting Twitter and other news sources saying, hey, look at this. And believe me, opportunistic traders love breakouts. So what happens is you start to see people move into positions and squeeze all of these sellers out, and that's what causes some big moves. And we can go back and look a year ago and see back when a lot of people said I was crazy saying yields were headed lower and bond prices were higher, you see another accumulation pattern here, a much longer one. And look what happened when it broke higher. It squeezed out the sellers here, then it squeezed out the sellers here, and those sellers came back in up at this higher point right here and pushed it down, didn't get anything. Then it went up, started squeezing those sellers out, broke right through all the people that sold here, and boom, and off to the races. We're seeing another repeat of that right here, backed by the Fed buying and the large commercial banks buying. Let's take a look at crude oil because it's seen a similar trending pattern. Let's zoom in a little bit on it and maybe zoom a little more. And you can see it's riding this channel higher. And look, you have buyers here, buyers here, buyers here, buyers here, and buyers here. So what happens if crude oil starts to fall below, say, 37 a barrel? Then will these buyers buy again, or do they start to become sellers and then you get down to 35, potentially selling, you get down to 31, potentially selling, and all of a sudden you have all of the makings for crude oil to come right back down into the low $20 range. Guess what? Does the oil market probably know that? The big oil companies? Yeah, they probably know. They're laying people off. In fact, in today's news, ExxonMobil, who did not lay off in 2015, 2016, announced that this year there will be not layoffs, performance-based firings. And that is a big indicator because they didn't lay off last time. And those performance-based jobs, they're not low-end jobs. They're not. They said they're all going to be pretty much mostly white-collar jobs. Big indicator that crude oil is probably headed lower because it was built by speculation. The big players know that. How about emerging markets? Let's zoom out. You can see it's got a trend line growing here too. So if we see EEM fall, it could squeeze out the buyers here and then start squeezing through these buyers. And as I believe, there's going to be a major move down in emerging markets to come as well. How about the broad stock market, the S&P 500 closing below its 200-day moving average? It's got a rising trend line too. So you could see if it gets down much further under 3,000, it's just over 3,000 points, you see sellers here, and then you've got some more potential longs that are getting squeezed around 2,800, and you've got all the makings for a potential retest of around 2,100 or 2,200. If that holds, that's a pretty bullish move going forward. If it doesn't, well, then we're back to looking at that megaphone pattern, which we're going to look at here on the symbol SPY. Don't want too many lines on one chart, so we'll keep them separate. And you can see it's holding the upper end of this megaphone, suggesting the next move lower would likely break through the bottom of this megaphone and go below 2,200, below 2,100, and there's your big opportunity long-term in the equity market. So pretty interesting stuff going on as far as I can see. And it's all being led by the Treasury bond market. And now that we see an opportunistic break, I expect the banks are going to keep buying. The Fed is obviously going to continue buying. And beyond that, what you'll see is speculators and traders jump in on the bandwagon. Not to mention on Monday, we're going to find out how short the long bond speculators still are, or hedge funds are in the futures market. Remember, they're very, very short. So you get a rally going, and they're going to have to start exiting those positions. Remember, yields don't bottom until speculators are long. So I'm going to hold off. I have a few questions, but I like to keep these videos around 30 minutes long. So what I'm going to do, I've already recorded a video for Saturday. It's long, it's around 40 minutes of Q&A, and I'm going to go film the rest of the questions, so there'll be a shorter one on Sunday for you. Anyways, thanks for tuning in to the Bond Show this week, because things are about to get pretty exciting. If everything plays out as yields go down, that means stocks go down. It's very bearish for the broad economy, and all predicted by macro and the bond market. And now you kind of know, if you're new, why I love the bond market so much. I'm Steve Van Metre. Thanks for taking the time to watch. I'll see you on Saturday and probably on Sunday. And of course on Monday to just see how badly those speculators are going to get squeezed out of their Treasury shorts. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by a security and financial instrument or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. First, the capacity opinions expressed this video that I do not reflect the view of Atlas Financial Finance Inc. or Steven Van Metre Financial.